Karin Clemens, Managing Director and Lead Analytical Manager at Standard & Poor's, has accepted to outline for us the strategic implications Solvency II will have on the insurance companies within Europe. We have asked her, firstly, what are the key analytical elements they are closely monitoring?
It's important to note that the European insurance industry still benefits from quite a strong financial strength with an average rating in the A range. Having said that, I think the industry continues to face quite a number of challenges, and just to name a few, to start with investment markets, they've shown significant volatility. There remains the risk of potential future volatility. The low interest rate environment is certainly something that's of a concern to the life insurance industry. Second, very clearly the regulatory developments, Solvency II, that's creating a certain degree of uncertainty. What are the future capital requirements are going to be? And in our opinion, that's likely to have an influence on companies' product strategy, investment strategy. And thirdly, we continue to see quite intense competition in the property casualty market in a number of the major European insurance markets. And lastly, maybe coming back to the beginning of the investment side, another obvious area we are closely monitoring at the moment is the sovereign risk exposure. I think, generally speaking, if we believe that the reinsurers are probably, on a relative basis to the primary insurance market, strongest positioned in terms of their capitalization. Obviously, with the major net cat events we've seen earlier in the year, there's an earnings challenge here, certainly for that year. But generally speaking, we believe the reinsurers are positioned quite well, and then we will closely monitor how the net cat events we've seen earlier in the year, what bearing that will ultimately have on the pricing, and whether this will help to harden the premium rates. The large reinsurers are, and that would be equally true for most of the large primary or large international primary insurance companies. Most of them really we believe are well prepared. They have an internal model. And given that it is likely that capital requirements under Solvency II will increase significantly, it's become quite important for these companies to be able to have their internal models certified for the regulator, so that the internal model will really replace the standard Solvency II model. And we believe, to the extent they succeed in that, that could be a competitive advantage for them ultimately. As I mentioned at the beginning, I think there are still quite a few challenges which might place pressure on the ratings, although the number of negative outlooks has reduced compared to what we've seen last year. But I think for quite a while, the topics we discussed, the interest rate environment, financial market volatility, certainly the topic of sovereign exposure and development of sovereign creditworthiness, these are all issues which might put pressure on companies' ratings.